Welcome to the deep dive. In a world drowning in data, how does one company keep making waves?
It's a great question. Consistency is tough in tech.
Exactly. So today we're diving into Pure Storage's latest earnings. We'll look at the numbers, sure, but also the strategy behind them.
And what it really signals for enterprise data storage and, how businesses are changing.
Okay, let's get right into it. Second quarter fiscal 26 results ending August 3rd. Pure Storage didn't just meet expectations.
No, they really blew past them across the board.
So for those of us tracking this space, what's the big headline number?
Well, total revenue hit $861 million. That's a solid 13% jump year over year, which is good, definitely good.
13%, okay.
But what's really fascinating, I think, is the subscription services revenue. That climbed 15% to almost $415 million.
15%. And that's now what proportion of the total?
It's now 48% of total revenue, almost half. And that's key for their long-term picture.
Why is that shift so important? What does it signal beyond just the number?
It signals predictability. You see, it moves them away from just selling hardware, which can be, cyclical.
Right. Boom and bust cycles.
Exactly. This subscription model means more predictable, probably higher margin revenue. Investors love that. Plus, it makes customers stickier, harder for rivals to poach them.
Sticky customers, predictable revenue. Makes sense. And here's where it gets really interesting for me. They beat their own guidance.
They did, both on revenue and operating profit.
And the CEO, Charles Giancarlo, he called the macro environment variable and uncertain. So how do they pull that off?
That's the million-dollar question, isn't it? It really points to, incredibly strong customer confidence.
Confidence even when budgets might be tighter elsewhere.
Seems like it. Enterprises are clearly seeing Pure's platform not just as an IT cost, but as a way to unlock value from their data. It's becoming essential.
So less nice to have, more must have. What was the operating income figure?
Non-GAAP operating income was $130 million. That's a 15.1% margin, both ahead of what they'd predicted.
Okay, solid profitability. Now, looking forward a bit, subscription annual recurring revenue, ARR.
Right. ARR is now $1.8 billion. That's up an impressive 18% year over year.
18% growth in recurring revenue. And RPO, remaining performance obligations.
So strong. RPO surged 22% to $2.8 billion.
Okay, explain ARR and RPO for us. Why are these so crucial? Beyond just being big numbers, what do they tell you about the future?
Well, they're forward-looking indicators, right? They represent future money that's already signed, already contracted.
Visibility into future quarters, future years even?
Exactly. It signals sustained growth is likely, and it shows deep customer loyalty. They're not just buying for one quarter, they're committing.
So it builds a kind of competitive moat.
A powerful one, especially in a shaky market. These long-term deals show Pure is embedding itself deep in customer infrastructure. Makes it really hard to switch out.
And that underpins their ability to invest, I suppose.
Precisely. It gives them a stable financial base to keep pouring money into R&D, stay ahead on innovation. Oh, and there's storage as a service TCV, total contract value.
Yeah.
That grew 24%, hit $125 million. Again, shows that move towards services and long-term partnerships. It's not just transactional.
That commitment story is strong. And what about cash flow? Did that hold up?
Very robust. Operating cash flow was $212.2 million, and free cash flow a healthy $150.1 million.
And cash on hand.
They've got $1.5 billion in cash and marketable securities.
Wow. So what does that war chest, that liquidity, allow them to do strategically?
It gives them huge flexibility. They can keep investing heavily in R&D, maybe snap up some smaller companies through acquisitions if the right opportunity comes along.
Or just ride out any economic bumps.
Exactly. Ride out bumps without having to slash their growth plans. It shows financial discipline, generating strong cash from operations. Always a good sign.
Okay, so the financials paint a really strong picture. Stability, growth, profitability. But tech success isn't just numbers, it's innovation. What's driving this on the product side?
Right. And the big news this quarter, the real engine, was the introduction of something called the Enterprise Data Cloud, or EDC.
Enterprise Data Cloud. Sounds ambitious. What exactly is it? Why are they calling it industry changing?
Well, think about how most companies handle storage now. It's often scattered, right? Different systems, different silos tied to specific applications. It's complex, expensive.
And managing all that must be a nightmare.
The EDC aims to fix that. It essentially virtualizes all that storage, creates one massive, intelligent pool of data resources across the entire company.
So breaking down the silos.
Totally. replacing that patchwork with a single software-defined data service. They use their Pure Fusion software as the orchestrator.
Orchestrator.
Yeah, it lets you manage all your global data like it's one integrated cloud, even if it's physically in different places. You can set policies for performance, security, cost, resilience.
And apply them everywhere automatically.
That's the idea. Apply them across the whole data estate using software. The CEO said it helps unlock data value, lowers labor costs, reduces risk, boosts agility. It's shifting from managing boxes to managing data strategically.
That sounds like a huge shift, especially with AI demanding so much data access. But what about companies stuck with old systems? Is it hard to adopt?
Oh, sure. There are always hurdles. Migrating from legacy stuff, getting the organization on board, that's never simple.
Inertia is powerful.
It is. But the argument here is that the long-term benefits, lower costs, more agility, actually using your data make the shift almost essential now. You can't stay competitive with data locked away.
Makes sense. And did they update their actual storage hardware too?
They did. They rolled out next-gen products, new FlashArray XL, FlashArray SD, and FlashBlades.
Are these just faster boxes or is there more to it?
Definitely more. They're purpose-built for today's big challenges. XL is for mission-critical stuff needing top performance. ST is for ultra-low latency, like financial trading. And FlashBlades, especially the EXA version, that's engineered for massive, unstructured data. Think AI training, needing huge parallel power. These underpin that whole EDC vision.
Gotcha. Hardware enabling the software vision. Can you give us some real-world examples? Who's using this stuff?
Yeah, they mentioned a few. A big global IT consulting firm is adopting the EDC framework, trying to kill off their own data silos, consolidate apps, move off legacy kit entirely.
So using it themselves to be more innovative for their clients.
Right. And then there's a leading financial institution. They're using Pure, specifically Portworx.
Ah, the container data services platform they acquired.
Exactly. Portworx and the new FlashArray XL R5 hardware. They're modernizing, moving apps to containers and Kubernetes.
Which is where everything's heading for scalable apps.
For sure. And the projection for them. Reduce infrastructure space, power, and cooling by over 70% compared to what they had before.
70%. That's not incremental. That's transformative.
It really is. Think about the cost savings, the sustainability angle.
Absolutely. That 70% number must grab the attention of CFOs, CTOs. Even CEOs worried about ESG goals, right?
Definitely. It hits multiple C-suite priorities at once. Lower TCO, yes, but also agility, risk reduction, and a massive environmental win. Data centers use huge amounts of power.
So reducing that footprint by 70% was a big deal. It becomes a competitive edge.
A significant one. And that ties into something else they mentioned, the Meta partnership.
Right, the hyperscaler engagement. What's happening there?
It's progressing well. They're co-engineering with Meta. The first volume deployment is happening, and they recognized initial revenue in Q2.
Volume deployment of what exactly?
Their direct flash technology. That's where they integrate flash media directly, bypassing traditional controllers for better performance and efficiency.
Okay.
They're confident about deploying maybe 1 to 2 exabytes, possibly more, by the end of the fiscal year. This is replacing what they call Layer 1 storage media for Meta.
So the raw storage layer.
Essentially. And the impact is dramatic reduction in power, space, cooling, plus better performance.
If that works at Meta's scale, what does that mean for huge data centers everywhere?
Well, it raises a big question, doesn't it? Could this fundamentally change how the biggest data operations are built and powered? It's potentially huge for efficiency globally.
Beyond these massive deals, are they still attracting new customers?
Yeah, they added over 300 new logos this quarter. That brings their total to over 13,500 globally.
Including a lot of big names.
62% of the Fortune 500, they said. And their Net Promoter Score, NPS.
Always a good measure of customer happiness.
It's 81, which they cite as the highest in the industry.
81 is incredibly high for enterprise IT. That suggests real loyalty, not just satisfaction.
Exactly. Customers aren't just using it, they're recommending it. That organic advocacy is priceless.
And you mentioned sustainability earlier, that 80% less power figure.
Right, compared to traditional disk. When you think the data centers use maybe 1–2% of global electricity, and storage is like 20–25% of that.
The savings add up fast.
Massively, both environmentally and for the bottom line. It directly supports their claim of lower total cost of ownership, hitting those operational costs like power and cooling hard.
Okay, so a very strong quarter, lots of innovation, happy customers. What does their crystal ball say? What's the guidance looking like?
They're feeling pretty good, seems like. The CFO, Tarek Robbiati, emphasized executing on priorities for profitable growth.
And they changed how they give guidance.
Yeah, interestingly, they introduced a range now instead of a single target number.
Why the change?
They said it gives them flexibility for investments, which, could suggest they see opportunities they want to jump on and they're confident they can hit the range even with some spending variance.
Right, flexibility to invest in growth.
Yeah.
So what are the numbers for Q3?
For the third quarter, they're guiding revenue between $950 million and $960 million. That's about 15% year-over-year growth at the midpoint.
15% growth.
Yeah.
And operating income.
Non-GAAP operating income guided to $185 million to $195 million, also showing strong growth and profitability.
Okay, solid outlook for next quarter. What about the full fiscal year, FY26? Did they raise that?
They did, significantly. New full-year revenue guidance is $3.60 billion to $3.63 billion.
Up from what before?
Prior was $3.515 billion. That's a jump. It translates to 13.5% to 14.5% year-over-year growth now.
Which is higher than they previously expected.
Yeah, about 300 basis points higher. Their old target was around 11% growth.
Wow. And operating income for the full year?
That guidance also went up. Now $605 million to $625 million. Again, about a 10% year-over-year increase at the midpoint, and also up over 300 basis points from before.
Raising both revenue and profit guidance that much mid-year? That signals real confidence, doesn't it?
Absolutely. Strong belief in their momentum, their strategy, and their ability to keep taking market share.
So when we zoom out, consistent beats, raised guidance, strong innovation story, what are the core advantages that let them do this? What's their secret sauce?
Well, the CEO laid out 4 things he sees as sustainable competitive advantages. They're pillars, really.
Okay, what are they?
First, the unified Purity operating system. One OS across all their products, simplifying things for customers. Scale and simplicity.
Makes sense. Second.
Second, the evergreen model. This is huge. It's their subscription approach, always on, always modern storage without disruptive upgrades. Customers essentially subscribe to innovation.
So no more forklift upgrades every few years.
Exactly. Eliminates that pain and cost. It makes them incredibly sticky. Third is Purity Direct Flash, the tech we talked about with Meta. Unmatched performance, less power, less space. Critical for dense data centers.
Okay, Purity OS, Evergreen, Direct Flash. And the fourth?
Fourth is their cloud operating model. That's Evergreen One, their storage as a service, and Pure Fusion, the orchestrator. Together, they let customers build their own enterprise data cloud, bringing cloud simplicity on-prem.
Those 4 sound like a powerful combo. Unified OS, the Evergreen subscription, the efficient flash, and the cloud model.
They really form the foundation of their whole strategy, addressing modern data challenges head-on.
If you had to pick just one of those 4 as the biggest game changer, the one that really messes with the competition, which would it be?
That's tough because they work together so well. But if I had to pick one, probably the Evergreen model.
Why Evergreen?
Because it fundamentally changes the business relationship. It moves away from just selling hardware boxes to selling a continuous data service. That subscription model, guaranteeing no disruptive upgrades, creates incredible loyalty and predictability. It's a business model innovation as much as a technical one, and it's really hard for traditional players to replicate.
That makes a lot of sense. It shifts the whole value proposition.
Yeah.
So wrapping this up, what does Pure success in this whole shift towards simpler, more efficient data management mean for the broader tech world and, for you listening?
Well, as companies like Pure make data easier to manage, more virtualized, especially for AI, data stops being this siloed burden and becomes a real strategic asset.
Available, accessible, usable.
Exactly. So the really interesting question becomes, when data isn't stuck in silos anymore, what new strategic possibilities open up? What new value can be created? And maybe more importantly, how will you leverage these capabilities, this newfound data freedom, in your own work, in your own organization?
That's a great question to leave people with. What becomes possible when data is truly unlocked and managed with this kind of simplicity and flexibility? Something definitely worth thinking about as you navigate your own data challenges and opportunities.